Assalamu alaikum, dear students. Welcome back to the class of business studies. Dear students, today is our 8th lecture of business studies. Dear students, recall from the previous lectures, we studied the human resource management in the lecture 6. We also studied the marketing manager in lecture 7, and today we will discuss the financial management department. Let's discuss the financial management department of an organization. Dear students, we will discuss in today's lecture that what is financial management, what is the goal of the firm, and organization of the financial management function. These three objectives will be for today's lecture. After the completion of today's lecture, we will be able to know about the financial management of an organization. We will be able to know the goal of the firm, that what is the goal of the firm, and we will be able to know about the financial management functions. So let's start with the financial management. First of all, we must know that what is financial management. Dear students, today we specifically concentrate on the financial management department of the organization. So, first of all, we are supposed to know the definition of the financial management, that what is financial management. Dear students, financial management concerns with three parts. The definition of financial management contains three parts. It's formulated from three parts. The first part of the financial management is acquisition. You can see it's written here. Acquisition. The second part of the financial management's definition is financing, and the third part of the financial management definition is management. So if any person asks you that what is financial management, you simply can answer that the financial management concerns with the acquisition, financing and management. Why they do these three functions? With their overall goals in mind. They have a goal for these. Why they do acquisition, why they do financing, and why they do management? Because of overall goal in their minds. They have an overall goal in their minds. So now, what is acquisition? Acquisition means investment, acquiring something, purchasing something. If a person purchases a land, builds a building on that, and gives it on a rent, so it means that the purchasing of a land is an investment. Again, building a building on that land is again investment, and then giving on rent is a profit, income, cash inflow. So acquisition means purchasing something. If you purchase a car for the purpose of taxi, so it's your investment, it's your acquisition. If you purchase a machine to produce something, so you invested something, it means investment. Then financing. After all, after that, when you started, when you invested, when you purchased a machinery, a land, a building, anything you purchased, after that, after the purchasing, when you want to expand your this business, so in that time you need to raise fund for your expansion. So this raising of fund is called financing. From where this fund comes for the investment. Financing means from where the fund is coming for the investment decision. So once you decided that from where to bring the fund and where to invest, after that you are supposed to manage the acquisition part and financing part of your decision. So third decision is management. So let's discuss one by one. Investment decision. Investment decision mean acquiring decision, acquisition decision, the first part of the financial management decision. What does it mean? It's most important is of three decisions: the acquisition decision, the financing decision, and management decision. So investment or acquisition decision is a very important, most important decision in all these three decisions. So what does it say? What is the optimal firm size? What will be your firm size? Optimal firm size. How broad your business be? How broad your business will be? Either your business or your firm, your organization operates in a global market or in a local market. This is called the firm size. What specific assets should be acquired? Which asset is necessary to be purchased? And what assets, if any, should be reduced or eliminated from your business? If any type of asset is surplus in your organization, so it must be eliminated, it must be reduced from your business. So this is the investment decision or acquiring decision or acquisition decision. The next decision is financing decision. Financing decision means it's the left hand side of balance sheet. And you better know about the balance sheet. The balance sheet shows the financial position of your organization. Everything has been written in the balance sheet. So the financing decision is left hand side of the balance sheet. Will be financed with the right hand side of the balance sheet. So in right hand there are liabilities and equities, and in the left side there are assets. So how the left hand side assets should be financed with the right hand side of the balance sheet. So what is the best type of financing? It means that there are plenty of ways to raise funds for your organization. So finance your organization, such as you can see banks provide credit, banks provide debt to the organization, banks provide funds to the organization. Capital market, you can sell your stocks in capital market, you can also raise funds from them. Insurance companies also provide funds. Mutual funds organizations also provide funds to the organizations. So these are all ways to raise funds for your organization. So which is type of financing is best for the organization? What is the best financing mix? If you get some debt from bank, financial institution, you also get some funds from the mutual funds, some from the stock market, capital market. So this is called the financing mix. What is the best dividend policy? If you sold your stocks in capital market, in stock market, so what will be your dividend policy? How will the funds be physically acquired? How easily you can funds acquire for your organization? So the third part is the management decision, asset management decision. How do we manage existing assets efficiently? Efficiently mean efficiency. 2 plus 2 is equal to 5. Well, never ever 4 equals to 5. 2 plus 2 is 4. How we can say that it is equal to 5? It means that by $4 you will get the profit of $5. By 4 people you can get the work of 5 people. By 4 machineries you can get work of 5 machineries. So it means that if there is a good management, you can efficiently get the assets. Financial managers has varying degrees of operating responsibilities over assets. Some assets are used before the another assets, and the priorities, which asset must be performed first and which asset will perform second and which asset will be used in third. So this is the priorities, and these are the varying degrees of the operating responsibilities. Operating responsibilities mean operating cash, how much you will use, how much you will keep the liquid cash with yourself. So different financial managers has different views about the operating responsibilities. So greater emphasis on current assets. Greater emphasis on current assets means current assets are the assets which are easily converted into cash, such as cash, account receivables, inventories. You simply can sell your inventories and get cash. So cash is the most liquid asset with your organization. So greater emphasis on current assets. Organizations have a more emphasis on the current assets, on the cash. They must have cash with themselves. Then the fixed assets management, such as long-term assets, such as organization, building, machinery, they are not easily converted. They are not easily and quickly converted into cash. They are long-term assets. They are fixed assets, such as vehicles of the organization, machinery of the organization, land of the organization, building, office furnitures. All these are long-term fixed assets. So they will not be easily converted into cash. So financial managers will always will concentrate more emphasis on current assets, on cash, on liquid, on account receivables, or on inventories because of liquidity. What is the goal of the firm? Why organizations do all these activities? Why they perform all these activities? Because of maximization of shareholders' wealth. Who are shareholders? Shareholders are the owners of the organization. So they always try to maximize the wealth of owners, the wealth of shareholders. Why they do investment? Why they do finance? Why they do management? Because they have overall goal in mind. If you remember, in the start of today's lecture, we discussed that it's a financing, it is investment or acquisition, the financing, and the management decision, but some overall goal in mind. So what is that goal? That goal is the maximization of shareholders' wealth, the maximization of owners' wealth. And this maximizations occur when value created in the organization, when the share price of the organization is maximized for the current shareholders. So this is value maximization. Most of the organization do profit maximization. They increase profit rather than value. Before we studied that the goal of the firm is to maximize the shareholders' value. But there's most of the organizations concentrate on profit maximization rather than value maximization. Value maximization is the maximization of share price in the market, maximization of value of the shareholders. But profit maximization is only profit maximization for shareholders, for owners. Maximize firms' earnings after tax. When they pay tax, so after tax which remains the profit, they concentrate on that profit. They concentrate on maximization of that profit. So there must be some problems. What are these problems? Could increase current profit while harm the firm in long term. Currently they maximize the profit of the firm, but the organization will be affected in the long term. Organization will be harmed in the long term, such as defer maintenance, issue common stock to buy 3-year bills. So all these are the problems which organization will face when they concentrate on profit maximization. And also they will ignore the changes in the risk level of the firm. So the problem which will occur in the long term, that is a risk. So they ignore that risk. Next, most of the organizations also concentrate on the earnings per share maximization. They pay dividend to the shareholders. So maximizing earnings after tax divided by share outstanding. So they pay the dividends to the shareholders, profit to the owners. So this also will bring some problems to the organization. What are these problems? Does not specify timing or duration of expected returns. So today is a different profit. After 1 year, there will be different profit. Before 1 year, there was a different profit. So the owners of the organization, the shareholders of the organization will not be able to find out the timing and duration of expected return, that what will be their expected return in the future. Strengths of the shareholders wealth maximization, which we discussed before. What are the strengths of the shareholders wealth maximization? It takes account of current and future profit. It means that they also concentrate on current profit, they also concentrate on future profit, they also concentrate on earning per share, they also concentrate on timing and duration of the expected returns, they also concentrate on risk and profit of the earnings per share, dividend policy, and all other relevant factors. So these are the strengths of the shareholders wealth maximization. It means that, it concludes that organizations must concentrate on shareholders wealth maximization rather than profit and earnings per share maximization. Because in shareholders wealth maximization or value maximization, they concentrate on all factors such as current profit, future profit, earnings per share, the timing and duration of expected returns, the risk of profit, risk of profits and earnings per shares, dividend policies, and all other relevant factors. So this is the strength of shareholders wealth maximization. So next topic, that is modern corporations. Today's corporations, modern corporations, are divided into two parts. The first part is shareholders, and the second part is management. If you remember, we also discussed in the types or forms of the business. That was the corporations. The corporations are artificial entity. In corporations, shareholders will not perform any type of activity in the organization. Only management will be responsible for the running or for the success of organization. So modern corporations are divided. There is a separation between the shareholders and management. Managers are separate and shareholders are separate. Managers are separate, owners are separate. So managers are responsible for the organization's success and failure. Shareholders only get profit from the organization. So there exists a separation between owners and managers. Role of management. What is the role of management? Management acts as an agent for the owners. They are agents for the owners. They are agents for the shareholders. So agent is an individual authorized by another person called the principal to act in the letter's behalf. So who is agent? It is an individual, it is a person who is authorized by another person who will work for the principal, who will act for the principal, for the owner, for the shareholder. Clear? There is an agency theory. There are some theories regarding agents. Jensen and Mackling developed a theory of the firm based on agency theory. Agency theory is a branch of economics relating to behavior of principal and their agent. What is the principal's behavior regarding agents, and what are the agents' behavior regarding the shareholders or owners? So this theory was developed by the Jensen and Mackling. It's the branch of economics. What says agency theory? Principals must provide incentives so that management act in the principal's best interest. Behavior of the principal, behavior of the owner, behavior of the shareholder must be in kind, that they must provide, they are supposed to provide incentives, benefits to the management, through the managers. Then managers will act in the principals or in the shareholders' best interest and then monitor results. What are these incentives? Include stock options. You must give some stocks ownership to the managers. This is an incentive, this is a benefit. Some prerequisites, perquisites, some bonuses, some facilities to them. What are these facilities? Managers must be provided with a good office, with a car, with a house, with rent, price. All these benefits must be provided to the managers. Then manager will act in the principal's best interest. If the behavior of the owner, behavior of the shareholder will not in the way that they will not provide any kind of incentives, any kind of in stock options, any kind of prerequisites and bonuses, then in the behavior of manager will also change. The behavior of the behavior of manager will be self-interested rather than organizational interest, rather than shareholders' interest. So this is agency theory. Organization of the financial management function. What is the organization of the financial management function? Every organization has a board of director. Board of director means it depends on the policy of the organization. Most of the organizations have 12 to 20% board of directors. They are board of directors. They are finally responsible for the organization's failure and success. After the board of directors, there is a president, which is called chief executive officer, CEO. After the CEO, there is vice president of operations, there is vice president of finance, there is vice president of marketing, there is vice president of HR, human resource management. So all these are after the chief executive officers. So now, as we are concentrating specifically to the financial management department, so what are the financial management department's functions? Vice principal of finance is in the top. Under the vice president of finance, there is a treasurer and there is a controller. Two persons. There is a treasury department and there is a controller department. What are the functions of treasury department? They work on capital budgeting. They work on cash management. They work on credit management. They work on dividend disbursement, financial analysis. They plan. They work on pension management. They work on insurance management. They work on risk management. They also pay taxes, tax analysis. They also pay tax planning. But there are some performances, some actions regarding controller. Controller make cost accounting. What is the cost of the organization? Cost management. They manage cost. They maximize cost. They also work on data processing. They also work on ledger. They work also government reporting. They provide reports to the government. They also bring internal control in the organization because they have cost management. So therefore they bring internal control in the organization. They prepare financial statements such as balance sheets, such as income statements, trial balances. And they also prepare budgets for the next years, for the upcoming years. And they also prepare forecasting decisions. They also forecast that what will be our profit, what will be our budget for the next year, what will be our cash flows for our organization. So these are all functions regarding the financial management department. So this was your today's lecture. Thank you so much. Thank you very much. Have a nice time. Have a good time.